was the most bullish person in the entire world, or at least the United States by far, back in the 80s and 90s when everybody thought, oh my gosh, Japan and East Asia is going to take us over. We've had our day in the sun. We're no longer leading the world in anything. And I'm like, no, look at all the high-tech industries. And on top of that, look at the baby boom generation. This was a global phenomenon, but we had the biggest, best baby boom generation and highest educated. And I was just showing people in the early 80s how they were going to cause the greatest boom in history into 2007, which even exceeded some of my predictions because I could show how big. I just lagged the birth index forward 46 years for the actual peak in spending of the average person in this country. It's 47 in a lot of other countries, but it's a very accurate thing. And it said, greatest boom in history. And then in 2008 forward, well, you got the baby bust dragging us down until now. Currently, the millennials kick back in, but the millennials will never be the force. Everybody says there's more millennials than baby boomers, but I look at the size of a wave for economics, and the baby boomers was a wave we have not seen before and will not see afterwards, especially as a maturing country in most developed countries. So the real story is, okay, well, 2008 hit, and suddenly, for no reason, boom, we're in the deepest recession since the Great Depression. Well, no surprise to me, but what was a bit of a surprise is the government's Ben Bernanke thesis was the Great Depression. So he knew what a Great Depression looked like, and I saw 2008 just like 1930. And he saw the same thing. So he just stepped on the pedal. And, he and the Fed and public officials thought, okay, well, this is just a short-term financial crisis. We'll get over this and we'll be back to normal. No, my research says no. It's going to take 12 to 14 years to bottom, not till 2022, 23. And so that's why we've had so much stimulus. The first trillion turned into $27 trillion. Nobody's put that number out there. I counted it all, okay? And 19 of it is massive government deficits, and the other 8 or 9 is money printing, just printing money out of thin air and injecting in the economy. The money that's the deficits goes more directly into the economy, and the money that is printed goes more directly into financial markets. So both economy is much stronger than we would have seen, and stock valuation and all are much higher than we would have seen. And we had the greatest boom continue, crash in 2008, early 2009, but now we've had stocks go to massive new highs. So from my point of view, the biggest existential question for markets now is, did we successfully skip over what I would have seen as more like the 1930s? I have a 4-season cycle, and that would have been the deflationary downturn, 1930 to 42 part of the cycle over 2 generations, baby boom and millennials. Did we just skip over a depression and there's no cost to that? And now we just go sloshing into the millennials boom, which started at the beginning of 2024. And I think not, because the problem is people don't understand. Everybody thinks recessions are the enemy, especially Federal Reserve. Their job is to keep the economy growing at something like 3 to 4% with 1 to 2% inflation and really never have a recession unless we really have to. Recessions are the best thing the economy does. I know this. I was a turnaround manager early on for Fortune 100 companies and then for small business. That's what I did in the 80s, turn around failing companies. Failure allows to wash out the losing companies, the zombie companies, restructure bad debts, which people never do unless they're forced to, and clear the decks so you can stay healthy and grow again. Recessions are necessary. We've had a major recession every decade, once a decade since World War II, and now all of a sudden geniuses at the Federal Reserve who've never had sex or run a business, by the way, okay, most of the economists there. I think that we should have an economy that always grows and doesn't have recessions. This is insane. If we stopped having recessions, innovation would crawl to a damn near halt, because people are at their best, and anybody knows this in wartime or a crisis. People become heroes, when there's a crisis. So to me, it shows the misunderstanding of the economy by the people who are supposed to be steering it, which is number one, an error. Free market capitalism says we don't need steering. We need rules of how to play and compete fairly. We do not need to steer the economy. We let it grow from the ground up. That's exactly what the invisible hand, Adam Smith invented this whole concept in the late 1700s. He called it the invisible hand. What I say now, folks, is all we have is the visible hand, and it's doing the wrong thing. It's suppressing the economy from flushing out the massive bad debts and zombie companies created in the last greatest, and it was the greatest boom in history, and nobody thought that was going to happen except for me back then. There's two things. They do measure. Zombie companies are companies that are only alive because they're not paying their debt service. So they're able to barely stay alive by operating, but they have to stiff their creditors due. So they're basically technically in bankruptcy, but still operating. They're probably more private companies because smaller companies, that aren't public, even the small cap companies are huge in the big realm we deal in stocks and stuff in the stock exchanges. So it'd be more small companies. But no, there are plenty of large companies that are in the same position. The other thing is there's an excellent measure of this. It's called money velocity. Money velocity is only positive, and this is the whole economy. It's measuring government, consumers, and businesses. When all of us are investing money, getting good returns on it, and then reinvesting those returns and getting returns. Money velocity will only keep going positive if that's happening. Well, guess what it's been doing since 1997, right after the first tech bubble stopped? Falling like a rock. Guess what the last time it did that was? 1918 to 1932. The entire roaring 20s bubble was saying what you said earlier, malinvestment, unproductive investments are being made. Why? Because money's so easy and not having recessions to shake out the zombie companies and all this sort of stuff. So money velocity has had a bigger drop this time than it even did into the Great Depression. So money velocity would have been the number one indicator back in the roaring 20s that would say, wait a minute, this is not a normal healthy boom. This is a bubble boom, a lot of overinvestment, a lot of malinvestment in unproductive things that are not paying off and being reinvested. And money velocity reflects that long before the economy does. So this should not have been a surprise to anybody. Economists don't study this because they don't like it. Let me describe excess for you. Out of that 27 trillion I described, most of it, 40% of it, 11 trillion came from COVID, the 2 years after COVID. So they're the ones that caused the 9.3% inflation. They're the ones that forced them themselves to pull back and tighten. They were tightening an economy already running away because they dumped 11 trillion of it. It's like 80% of GDP in it a couple of years. And remember, the fiscal side was 2/3 of all this 27 trillion stimulus, including that 11 trillion in 2 years after COVID. And the money printing was 1/3. So it's been the government deficits. And now we've stopped printing money. They even reduced the balance sheet 2.2 trillion. So that's starting to tighten, but the government deficit's still 2.2 trillion a year. So we're now getting closer to neutral instead of stimulative or tightening. But to me, in an economy in this big a bubble that's so overstretched with so many bad debts and zombie companies, even neutral's not. I mean, the only way to keep a bubble going is to keep upping the ante. Right. That's true of any bubble, any exponential trend in history. So they're in a bad place. And again, they created the stimulus. If $1 trillion a year for a couple years wasn't enough, then they should have let the economy go in a recession, okay, and let the economy flush out and clean up the economy, because the economy is very good at that, by the way. It does it very quickly, very efficiently, because it's merciless and it just lets the companies go that can't survive a shakeout, and it cleans it out, and nobody has to make the choice. So the deficit's larger than ever. And I can tell you one thing right now. If I'm right and we're close to going in a recession and you got a 2.2 trillion deficit at the top of a boom, that deficit would double to 4 trillion in the first year of the recession and keep going up. Now you see debt going from 36 to 38. Next thing you know, they're projecting 50 trillion and blah, 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 blah. And then the bond market starts raising yields and say, oh my gosh, the 10 and 30-year treasuries don't look like risk-free bonds anymore. And now you got to pay 5-6% interest. They got to, charge 5 to 6% interest instead of 4 and blah, 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 blah. And so this is just over stimulus. Everybody believes in free market capitalism until something goes wrong. Right. And people think recessions are bad. Recessions aren't bad. The government has not run a balanced budget since 2001. And I'm just counting the deficits, 19 trillion since the 2008 recession. They have reacted by just saying, well, we'll just keep running bigger and bigger deficits. And Fed is saying we'll keep printing money when we need to. So what they do is try to just artificially stimulate your way out of a Great Depression. I like to call it a shakeout. Shakeouts are necessary in business. I have a model in every one of my books. Innovation, growth boom when they first move mainstream, shake out down to the leaders that really bring it cost effective and make it mass affordable, and then a maturity boom to mass markets. 4 stages, 2 booms, 2 busts. The booms are longer than the busts. It's all a natural cycle. And suddenly my problem is the people, especially at the Fed, governments too, governments just doing what they do now. People at the Fed think they should make the economy a machine that just grows at 3 to 4% a year with 2% inflation and no recession. They're saying that, which means they've totally rejected free market capitalism, the thing that's made us the richest in all of history. You can't even compare the last 250 years to any period in history with the progress we've made since free market capitalism and democracy got married. And by the way, those are opposite concepts. That's the way they work. Well, I tell you what is most unique about this downturn. The roaring 20s was majorly a stock and a business. I mean, unbelievable stock bubble and business bubble and all that sort of stuff. It was not a real estate bubble. Real estate loans back then were 50% down, 5-year terms, and you had to be much richer to qualify, okay? Now, real estate is the biggest part of this bubble, and it's global. Everybody's been able to buy real estate at almost no money down. Now, forget 10 or 20% down, almost no money down at very low interest rates. And so that's what's allowed there to be so much debt. And again, there's nothing wrong with borrowing in a boom as long as it's some relationship to the actual growth and you've got a great gauge that no economists pay attention to because it would tell them they're doing the wrong things most of the time. Money velocity. Right. If money velocity is flat to going up, it's meaning this is healthy growth. If money velocity is dropping, it's saying no, businesses and consumers and governments are not investing money productively. That's a bad thing. That means the debts are not going to be able to be repaid.